the new all the news around Twitter, right? Elon Musk jumping in, getting financing, buying Twitter, and it seemed like it all happened over a weekend. I mean, I have my own thoughts on how this is on kind of some of the drivers and how this is going to affect, in particular, the crypto environment. But Lee, I would love to hear from you. Kind of, what are your thoughts around this? I mean, this happened really, really quickly.
Yeah, it did. I mean, this is obviously the biggest story in business, in a long time. I guess maybe since the GameStop, the meme stock stuff. I don't know how I feel, but I mean, in some ways, I just don't care, to be honest with you, like who owns, Twitter. But I do use Twitter, right? And this is what I want to talk to you about, because I know you're a frequent Twitter user as well.
Yeah.
And it plays such a critical role in the crypto ecosystem, right? I mean, there's even this, crypto Twitter, as it's referred to, right? And I've talked often about, I mean, in the past, obviously, Jimmie, that I think, crypto is a bubble, right? And all bubbles throughout history are fueled by narratives. And, social media has allowed the crypto narrative to expand, to spread, and draw in new adherents. And not only draw in new adherents, but create a cohesive community of true believers. And so, as easy it is to laugh at things like the memes and whatnot, they actually do play a critical role in the crypto ecosystem in communicating, amongst the believers, right? Like, kind of, this is our inside knowledge, right? Only you have this, and you kind of get these memes and whatnot. And it also, social media allows the believers to attack, the skeptics. And, I mute my Twitter mentions, so, people can hate on me all they want, I'll never see it. So, it's the only way to keep your sanity in this world. So you see, repeatedly when people kind of, voice a skeptical opinion, the crypto horror kind of swarms. And so I think, if anyone out there is a sociologist or studying sociology, right, I think there's an interesting paper or thesis in here kind of about the role of social media. So, so that's kind of where I'm coming at this from. It's kind of, how will this change that dynamic, if it changes it at all? Because we all know that Elon has been, having fun with Dogecoin. Is a believer, appears to be a believer in kind of blockchain and decentralization and whatnot. Of course, he is, advocating for free speech on the platform. Now, again, as a user, and I use it for other things other than just crypto too, I'm not too excited about the potential for, Twitter turning into a place for conspiracy theories and, white supremacists, sponsored content from the Oath Keepers or something like that. So that does concern me. It's just like from a product quality standpoint, because if it turns into this sort of conspiratorial cesspool, people will leave. And people
will leave. People absolutely. People will just flee, and it will attract those people who are attracted to such things. Yeah.
So I get the desire for free speech, but it's a product, right? Like, you have to make it desirable for people to use it. And I think if you push free speech too far, it'll actually undermine the desirability of the product, and it could backfire. So I don't know if he actually wants to. I mean, he's taking it private. He obviously is taking on considerable debt to do this. Presumably he wants to make a profit, but I don't know if his vision for it is actually a profitable vision. Of course, Twitter has struggled with how to monetize its stuff for a long time. So it's a lot of question marks for me. I worry about what it's going to do to the product, and I'm just curious to see what it's going to do for crypto Twitter and digital assets in general. So that's where I'm at, but want to hear your thoughts for sure, Jimmie.
Yeah, no, I think that he's shown that he's been able to turn a profit on a lot of things, right? And I mean, there were a lot of naysayers out there when a few years ago, when people said, "Oh yeah, this Tesla thing, this will never launch, and then it'll be, well, he'll never get a critical mass." Well, this, well, that, and he's proven that he can do this pretty well. Some things, and whether this will be it. I mean, the one thing that he's acquiring is this phenomenally huge global user base, right? I mean, to assemble something like this again would be, really, really difficult. It's not certainly not impossible because we see these kinds of platforms grow. I think for, to do this though, again, would be really difficult. So he's acquiring this huge user base that's on already a pretty user-friendly platform. And so, I mean, I'm wishing, I'm hoping for the best. I think the whole free speech thing is, like a lot of things, maybe a little bit of a diversion tactic, that there's a lot more coming, that this is going to be a lot bigger. And in, a year or 18 months, we're going to say, remember Twitter? Remember what it used to be? I really feel that could be the case, that this turns he's using this as a real opportunity to do something much bigger than just for, I don't know, allow for edits or something like that. There's going to be a lot more there. Gotcha.
And what about impact on crypto, if at all?
Yeah, I don't know. I mean, crypto users will migrate if it's no longer attractive, and this goes for any user. If it's no longer attractive, they'll go to something else. It's too easy to start up another kind of platform. I think people will continue to use it though for a good while. I mean, I'm seeing more and more stuff being done in Twitter, more and more things like this, podcasts in Twitter. I mean, I've done a couple of recordings in Twitter.
Twitter Spaces, which is kind of, I mean, remember when Clubhouse was a thing like last year, right?
Oh yeah.
No one talks about Clubhouse. Twitter Spaces has just absolutely killed Clubhouse stuff. Yeah.
It's, I mean, there are certainly people out there that are using it that are, taking advantage of some of the things. I mean, I think there are some nuances to it that are a little bit difficult to get used to, but that said, we are seeing, I think we will continue to see people use it in the crypto space for sure. And if it gets to a point where it's either too hard or there are too many rules or it just doesn't work anymore, people will migrate to something else because we have no shortage of really cool inventions out there and people willing to try them out, like Clubhouse. I think there are, by and large, people that are using crypto. These are people that are looking for what is that next cool and thing out there. I want to try it. These are not people that are going to sit back and wait for somebody else to try out the new thing. They're going to embrace it.
Yeah, they're not on Facebook, right? So it's right. Exactly. Something your parents use. I don't know if you saw Jack Dorsey's statement or tweet. I think it was yesterday, and he's supportive of Elon taking Twitter over. But he said something like, in an ideal world, no one would own Twitter. And he kind of basically was talking about Twitter operating as a DAO. Yeah. And, and I know he's kind of back in St. Louis and really thinking about the Web3 thing. And he kind of seems genuinely, he's kind of this mysterious, character, I guess. But he actually does seem genuinely interested in the purity of like Web3, right? Because remember he got into it a little bit with Mark Andreessen, and Andreessen blocked him, and that's kind of one of my critiques of sort of Web3. It's like the most vocal advocates for it are the VCs, who are classic intermediaries. So I'm kind of not buying this like power to the people thing coming from very wealthy investors, but. But what do you think about Dorsey's kind of plans here for for Web3 and decentralized internet?
So I mean, it's interesting. Jack is someone else who has certainly been very supportive of new efforts, and we all hear about the great ones, but I'm sure there are some that have fallen along the wayside too. I think kind of retrenching a little bit in the St. Louis space. Most of I spent a lot of time in St. Louis, and it is a space unto itself. But kind of retrenching there a little bit, he brought a lot of people into the area. I think that moving into the Web3 space, changing some of the characterization of the company of Square, some of those kinds of things that have happened. It seems like he is pushing, maybe organic evolution a little bit faster than it would normally go. And I'm a huge fan of that. I mean, I absolutely love seeing that. I think this idea of DAOs, it's funny, this is coming up more and more. I teach blockchain here at Duke, and I teach at Duke for the students who are on campus, but I also teach a Coursera course. And this idea of DAOs is coming up more and more frequently as almost I don't want to say a replacement for, stock companies, but certainly as an augmentation of stock companies. And I almost look at DAOs as maybe that was what, the original idea was when people, in 1930s were drawing up the rules around what would be a stock issuing company or a corporation. It looked, I think, a hell of a lot more like a DAO than like what they do now. Where people actually had votes in a company, where there was that direct participation rather than these boards of directors that you never know where their allegiances lie and things like that. So I think this idea of a DAO, and I know this is a departure from what you asked, but I think we are going to see more of those. I think that's a notion that people who really believe in stock companies and things like that are going to embrace.
Yeah, no, I think we are going to see more of it. And like a lot of things in crypto, will the reality live up to the kind of the hype? And I'm a bit skeptical there because DAOs ask a lot of participants, and I question whether or not the average person is actually willing to. When I buy stock in a company, I get the annual proxy materials. Sometimes I review it. A lot of times I don't. But I'm busy. You're busy, right? I don't want to necessarily have to, monitor every single decision or weigh in on every single corporate decision. So, so I question kind of how big DAOs can get. But let's talk a little, Jimmie, about. I want to get your thoughts on a few things.
Hey, one more thing on that. On that, I have to stop for a second.
Let's talk.
I think that idea of participation, and it does require a lot. It does require you to be kind of active. That non-activity or that ceding your input to other people, I don't think that's global. I think that's a very American point of view. I mean, like in Australia, if you don't vote, you get fined for not voting. I mean, I know it's a tiny
for politics for elections. We're not talking about corporate.
Right. But I think it's somewhat representative that maybe Americans are more willing to cede that than people in other places. Maybe not.
It could be. No, I mean, culture makes a big difference for sure. Listen, ultimately DAOs are about solving the principal agent problem by effectively getting rid of the agent, right? And we're all principals. Now I would say economics has driven principal agent relationships, right? Less so than law, but you're right. Maybe we'll see. So let's talk DeFi, kind of related.
Okay, let's do it.
DeFi. We're getting to the end of the semester. That means time is freeing up. Really excited to start, dabbling in some things. I started playing this video game, Jimmie, this excellent video game, okay? It's like a digital, kind of Pokemon, Axie Infinity. I don't know, maybe you've heard of it. And I was, I had my characters. I was, winning battles, getting crypto, in-game currency, converting it to Ether. I logged in one day and it was all gone.
It's all gone.
All gone. So let's talk, Axie Infinity, $600+ million. I think it's the third biggest hack in crypto history. And I tell you, Jimmie, I have heard, before the hack, I have heard from so many crypto backers, including folks that work at Andreessen Horowitz, A16Z, point to Axie Infinity as an example of what the future of Web3 looks like, right? Where there's these, and they said, well, in the Philippines, they have all these people gaming, that they're, and they're actually making money playing, video games and whatnot. And, next thing you know, all that money's gone. I found it actually really interesting that apparently there's a plan in place to make those gamers whole. And they raised the parent company of Axie Infinity did an additional fundraise from, that included A16Z and others, which, normally when you have a spectacular failure like that, investors kind of walk away, right? So break it down for us here. I mean, there's obviously the technical aspects of this. I definitely want to get your thoughts there, because my understanding is that it had to do with a bridge, so getting from one blockchain to another. And I know, this deal with cybersecurity. So maybe just talk about kind of what happened from a technical standpoint and what this means for future of Web3.
Yeah, I mean, it's almost every hack, and I cringe at the word hack because I don't really think that's what this is. I would say,
be clear, and it was North Korea, right? So like evidence. So since it happened,
there is evidence it was North Korea.
There is evidence that it was state sponsored, right?
Yeah.
This was driven by North Korea, and North Korea has targeted other crypto platforms before.
Yep.
So this is not a first for them. So okay.
I would, yeah, they have definitely targeted this before. It was state sponsored. I would say this is a software vulnerability rather than a hack. And I do.
What's the difference?
Okay, so what's the difference? So to me, a hack is somebody actually using either brute force or some other means to actually crack a code to get into an account, to break into an account. Break into a wallet, break into just a regular account, your bank account, something like that. This was a software glitch, which allows people in almost like a backdoor or something like that. It wasn't a backdoor, but this is a software glitch. To me, this speaks very directly to it. And almost every hack that we've seen has been a bridge, by the way. Almost everyone that you've seen, that you've read about of any kind of size, has been a bridge like this.
Okay. So what's a bridge?
So a bridge allows you to cross networks, basically, cross from a network that is, say, friendly to a different network. So this is a huge deal. I mean, as writing software for these kinds of things is, I mean, monumental. This is why we don't write Fortran that will, run Python. It's very, very, this is a difficult thing to do. When you're doing it with a bunch of open source coders, it becomes even more difficult to do. Not that these guys aren't good, because they're really good, a lot of them, but I think they don't have, it's very, very hard to put in, QA, real QA type structures and things like that when you're working along these lines. And so these bridges, often facilitate things. So for instance, if you're a nativist kind of in the Bitcoin space, that you can create smart contracts. Well, in BTC, you can't. If you wanted to go from one to the next, you have a network that facilitates one thing, and you're trying to convert it to a network that facilitates a totally different kind of, different kind of experience, different kinds of optionalities. It's almost impossible. It's very, very, very difficult to do this. And so I think that's a big, I think the immaturity still of the crypto space, it comes through when you start to see these kinds of things. And again, not that there aren't some super smart people creating bridges, because there are, but because these aren't being done in the same way as a kind of a, I would say, a legacy company or a legacy software company that go through a whole QA process and, have a lot of people that are looking over their shoulders, it makes it really difficult.
So what does this then mean for the future of Web3? Because it sounds like this might not actually be technically solvable, or at least solvable given the current kind of governance mechanisms in place. And so doesn't this make it so we're going to end up in a walled garden environment where it's like, you're native to your blockchain and you're not allowed to chain hop, right? And then it's just whoever controls those chains is they have all the power, right?
I think that, again, I think this is the immaturity of the space. I think we will get to that point, but it might not be how we've traditionally done it. So we might be able to bridge things, but right now we're trying to bridge things like we've done it in the past. Maybe there is a kind of a new way of thinking about how to bridge. So think about all the, and I mean, I'm in an engineering school here. So think about all the different kinds of bridges that we've built over history, right? I think, those kinds, and different kinds of structures are used for different distances and different, wind speeds and things along those lines. I think the same thing could happen here. We're trying to use a very traditional approach to something that is cutting edge. And so, possibly there's a radical change that needs to be made. And I think this is the way that it will happen, though, allowing a lot of different people with a lot of ideas rather than saying, well, it's only these 3 companies can work on it.
Yeah. And
if you're not working for one of those 3 companies, you're out. I think having this idea of fostering open source ideas, and me, I'm a huge open source guy. I believe in that in a huge way. Yeah. But fostering this people that are thinking along those lines has a lot of promise to it.
Well, I'm going to point to Randolph's comment in the chat here where it says, it sounds like multi-chain solutions are inherently broken. And that's kind of, as someone who's not a technologist, that's kind of where I'm at, at the moment. To me, this is just another head scratcher, right? I think we all remember the Equifax hack, right, from a few years ago.
Yep.
And just remember how big of a story that was and kind of how outraged people were, Jimmie. And, there were, congressional hearings on it. And yet, to my knowledge, there's no evidence that any individual actually lost anything as a result of the Equifax breach. I think one of the fears was that, it could impact your credit score or something like that. But, I haven't heard of a single instance where someone actually lost money or value or was impacted. And yet, and we collectively kind of, were very upset as we should have been. I think that was justified. And yet you have something like this where you have poor people in the Philippines who had spent countless hours, and it sounded like digital serfdom, right? I mean, these characters were kind of lent to them.
I don't know. Yeah, I don't know.
To play. And we don't blink an eye, And it's like, oh well, and we just kind of take this as par for the course in crypto. And
so I think,
but 600 million was stolen from like JP Morgan, or 600 million was stolen from, people's Robinhood accounts or something like that. Why is this acceptable? Why isn't there more outrage from, even within the industry itself when things like this happen?
I think the outrage is probably overdone by how do we fix it as fast as we can. So I think outrage may come, but I think it's how can we fix it. But I would say, when you making comparison between Equifax and whether people lost credit or, had fake credit cards open up in their name, I have no idea. I haven't done that much research on it. I mean, obviously it was huge. I was caught up in it, but the Equifax versus, hacks and things like this, to me, are very different. Equifax, you don't have a choice. They're collecting your information and they're selling it no matter what. The other side of it, you do have a choice, right? So that's a very basic difference. I mean, I can't tell a credit reporting agency, no, you can't collect information on me. I can freeze my credit report now for free. They used to charge you to freeze my own information. That's free now, at least in North Carolina.
Yeah. So I have a choice to use Robinhood, though. Okay, let's just say, I have a choice to use Robinhood. Does that make it okay if all my money in my Robinhood account gets stolen?
No, it certainly doesn't. And I don't want it, but I didn't want to call it the comparison there. No, I don't think it's okay. And I think that the company seems to, as you said, seems to be making efforts to try to make people whole. They are going out and other fundraising around and things like that to try to make people whole. I do, I feel for these people. I really do, because if it was me, I would be, I would not be a happy camper if I lost, money in something like this. But I do think that, it is maturing. And I think there are, there's certainly a lot of people that lose money and a lot of other things that are out there. Sometimes they get compensated for it, and sometimes they don't. I mean, I think, you bring up financial services companies. What about all the companies that sold, Bernie Madoff? What about all the companies that sold, Stratton Oakmont? What about all those companies, and and nobody there was held responsible either. I mean, I guess Stratton Oakmont they were kind of, but not really. I mean, the people didn't get anything back. The SEC fines and stuff like that. But at the end of the day, it was still years and years and years before they got anything back. So that does happen in the traditional sense too. There are means to go and find these people, but it's I mean, you and I both know that if you lose money in one of these things, the chance of you getting anything back is slim and none.
Okay. So, but in the Madoff and Stratton Oakmont situation, you're describing a Ponzi scheme. So this brings us to, I think that.
I thought I would tee that up for you.
Yeah, you teed it up. You teed it up, Ponzi. So there's parallels here, right?
Yeah.
And of course, listen, there are people who have argued that the entire crypto ecosystem is just one giant Ponzi scheme, simply because you're just counting on new money to pay out old money, right? Like,
yeah.
You just need greater fools. I mean, so maybe it's not technically a Ponzi scheme, but in principle, it operates as one. Let's talk about DeFi, because I know this is something you're bullish on, and we've talked about on here in the past. Folks might be aware earlier this week, Sam Bankman-Fried was on the Bloomberg Odd Lots podcast, a finance-related podcast, and he was asked to offer his definition of yield farming, just kind of like what is a lay interpretation of yield farming. And he proceeded to essentially lay out what sounded a lot like a Ponzi scheme. Now, he never said it is a Ponzi scheme.
Right.
But the way he described it was very much a Ponzi scheme, whereas, he said, okay, like imagine a box, you put money into the box, mints tokens, gives a portion of the tokens to people who put money into the box. And those tokens are valuable because the community thinks that they're valuable for some reason, even though from an economic standpoint, they should have no value, right? Here we're talking about governance tokens. Right. So, what are your thoughts there, Jimmie? I guess, we have a lot of your students, so they're technical, they know the tech, but I'm sure we have people who are just kind of curious about this in general. How would you explain, yield farming to, your neighbor who doesn't, isn't immersed in this world?
Yeah, sure. I would explain yield farming the same way I would explain any sort of lending, fractional lending, any sort of lending scheme, in particular those that are revolve around hypothecation of securities, which is so for anybody who opens a brokerage account, unless you check the box, I don't want to participate. Your money all goes into what's called, all your securities go into what's called hypothecation. They're lent out. And so when you go to borrow securities, when you use your margin account, it's very, very similar, where you're depositing something and, people lend that out for yield. I mean, basically the same thing happens with your deposit at a bank, right? So I think that one, that was a terrible explanation. I hate to see people like that. But it made for a great story, right? From what I understand, in most yield farming type of operations, they're very much like hypothecation of securities. In the vast majority of cases, you deposit something and you usually have to lock it up for a period of time. It can be lent out and you get a portion of the yield on that lending. And in those spreads, you might say, wow, those spreads are pretty huge. But spreads in those kinds of, in yield in lending are always pretty huge. So just because I knew we were going to be talking about that, yeah. I looked this morning, and I don't know how many of you do this, but I look every morning and see what the national average of the 30-year fixed-year mortgage is. And this morning it was 5.42%. This is reported by Bloomberg on their rates page. Anybody can go look at it.
Yeah, which is up significantly in just a month.
Yeah, I know. Last year at this time it was 3.11, almost doubled in a year. But beyond that, the savings yield at Wells Fargo and Bank of America this morning, 4 basis points.
Yeah.
So less than 1/100th of what they're lending your money for are they paying out. Well, what if it was just the reverse? And I think that's what a lot of yield farming is. It's just the reverse. So if you looked at a bank and said, hey, you're making 99.5% on your loans, people would say, well, how could that happen? How could that be? But they literally are, right?
Yeah.
They're keeping everything and they're paying out almost nothing. This is, I think, just the reverse of that.
Yeah. Okay. Well, let's unpack this a little bit. And
okay.
Yeah, I'm with you because it's funny. Last week I got an email from I have a Mark. Goldman has the online bank Marcus, and when they first opened Marcus, they actually had some pretty decent, considering general rates, yields. But they knocked them down, and then last week I get an email saying, "Hey, by the way, your Marcus savings account yield is now 60 basis points." And I was like, "Oh wow, what a deal." Okay, so I understand in the bank context, right? Like I deposit my money, they take that money and they make loans to, for economically beneficial, purposes, right? Whether it's a small business that's trying to get off the ground, someone needs a mortgage, someone wants to buy a car. I understand that. I also understand, rehypothecation and securities context, right? So, I have a retail brokerage account. There's securities. Those securities get lent out to short sellers principally, right? And that was kind of the thing that the GameStop thing where people got wise to the fact that they could actually request the fact that there's securities not be lent out. I still struggle with kind of understanding, though, in the DeFi context, what is the economically beneficial activity that is occurring with, because it's primarily stable coins that are being locked in, right? So what
a lot of stable coins are being
what is I don't understand what is actually going on, I guess inside the box, to use the Sam Bankman-Fried. What is the economic, because it just all seems like gambling, right? I mean, it's flash loans and whatnot. What economic purpose is being served by these digital assets being lent out? What's going on?
So I think different platforms have different approaches to this. A lot of it, though, is very much like your hypothecation of securities to short securities, in particular on a very short-term basis and things like that. So traders are using your securities to make markets and often to short things, and they pay really outrageous rates to borrow money on a short term. One of the things that one of the kind of the secrets that people don't realize about borrowing money in the short term, and it kind of goes to your GameStop analogy, is that, if I want to borrow $1 billion, say I want to go out and float $1 billion, 10-year bond, this today I would probably cost me, 5% on a 10-year bond. If I want to do that overnight, it will cost me 5 times that probably, because they can. There are only so many places you can go to do this, and that people will, give you very, very short-term loans. And so like the GameStop, if you have to go and borrow $1 billion overnight, that's a hell of a lot more expensive than if you have to borrow $1 billion for 10 years, because they can. And so a lot of these are for traders and things like that. The one thing I think that's really different in the crypto space is, there aren't 5, or in the United States, there are about 55 execution venues. Of those 55 execution venues, only a few can really facilitate hypothecation securities and things like that. So think the big exchanges, right? In crypto, there is no, there are all these exchanges out there. I do think that's going to concentrate at some point. It has to almost. But you have people making markets on all these exchanges, and because I hear the question all the time, well, how many market makers can there be? Like, how many exchanges are there? Mm-hmm. And so, that's, I think, a lot of what facilitates this are people that really are borrowing funds for short term, and they're paying kind of outrageous rates to do it.
Gotcha. Okay. So there's shorting activity going on in the digital asset world.
Absolutely. There's no matter what the asset is, people will figure out a way to short it.
All right. Well, sign me up for that.
Yeah.
Okay. Well, that helps. And for folks, I see there's a few kind of comments, questions. Put the questions in the chat, and we'll definitely get to them, and we'll hopefully save time at the end. I think we'll have some time to take on questions too. So Charles, I'll come back to the exchange. Well, we can talk about it now. So Charles says part of the maturation process will be a financial restitution model that includes exchange insurance. Lack of regulatory clarity. Yes and no, I guess. On the clarity point, this kind of gets to one of mine, and I wrote. I should have shared it with you, Jimmie. Maybe you saw it on social media, but I published a blog post last week in the Columbia Blue Sky blog, where I advocated for the Securities and Exchange Commission to be given oversight over digital asset spot markets. And this is an area where there's a big gap right now, and it's a gap that's recognized by folks within the crypto industry itself, because Bitcoin and Ether, and by extension, other coins that resemble them, are considered commodities. And the Commodity Futures Trading Commission, they only regulate commodity derivatives markets. They don't regulate commodity spot markets. So these platforms, these exchanges like Coinbase and Gemini, as long as all they're offering are what are considered commodities, they're not supervised at the federal level. And so that means there's no market integrity rules, there's no conflict of interest rules, there's no, to Charles's point, there's no insolvency regime, right? So in the broker-dealer context, we have Securities Investor Protection Corporation, right? So if Schwab, God forbid, were to fail, that if you have your assets with Schwab, you would be compensated. That doesn't exist in the digital asset world, and I think it does need to change. Now, sure, I think they could go out and get insurance, and they do. My understanding, you probably know this,
yep.
The largest ones do have insurance. Now, they don't, for obvious reasons, publicize the details of those policies, right? But they do have third-party insurance. But I do think that there needs to be some type of government insolvency regime.
Yeah, so it's like brokerage firms. Almost every brokerage firm has insurance beyond the SIPC. Yep. In fact, I don't know of one that doesn't. I'm sure there is one, but I don't know of it. For retail brokerage firms, they all have extra. That said, if something catastrophic happened, they're not gonna. It's not going to cover it. But that's not going to happen. We're probably good there. But your
last words.
Yeah, I know. End of the markets. I think if that ever comes to pass, Lee, we're going to have bigger problems. But I think this idea of an insurance type of fund or different types of insurance funds certainly is viable, and it should be something that's explored. As far as the spot markets go, and I read all your stuff, so I read your blog. I always read your stuff, which is great. You put it out there on Twitter and on LinkedIn, so it's easy to find. You guys should follow Lee if you don't, because he writes a lot and he has some really great stuff out there. But one of the things that we argued is that this is very different. I'm going to put a link in here to a paper that we did a couple of months ago. Myself and two co-authors, and it was I think we showed that this is a very different kind of asset class. Should the SEC be regulating it, the spot market for it? Well, the SEC is not really. It's not really possible to regulate the spot market of something that's not in the United States. Remember, these occur in a virtual place. So, Bitcoin, for instance, is trading on markets all over the world. A lot of those markets don't allow U.S. investors to even participate in. So, to say that, to have the SEC say, oh, we're going to regulate this, they can regulate exchanges that are here in the United States, but so, if the exchanges aren't here in the United States, then it makes it much more difficult to do that. I do think that, in this case, the very, very, very fragmented regulatory environment that we have in the United States probably isn't the best environment to look towards. I think there are probably better environments. I would suggest places like the UK that have more singular authorities in over these kinds of assets might be a better tack to take, or maybe maybe this is a kind of a bellwether. This is a time that calls for us to start consolidating our regulatory structure in the United States. And so it's not, 3 dozen. I saw a thing the other day that there were, if you count states, there were 70 some regulatory bodies in the United States that govern financial services products.
Yes. Yeah. It's a mess. As I agree with you on first principles, but I think then it's a question of, well, what would that unified regulator do with their authority? And that's where we probably disagree. But listen, I mean, no one would design our system of financial regulation from scratch, right? It's a mess. It's a byproduct of historical accident and political accident. The classic example is the fact that we have a separate derivatives regulator from a securities regulator.
Yeah.
In most countries, that's in one agency. And in fact, there have been numerous attempts over the years to merge them. And Paul Volcker, famously argued that they should be merged. But, politics, as usual, kind of gets in the way because the CFTC is overseen by the Senate and House Ag committees. And the SEC is overseen by the banking and finance committees. And, as it turns out, if you're a congressman or a senator, those are pretty profitable committees to be on in terms of campaign contributions. So you're probably not too thrilled about giving up your oversight over the CFTC or something like that, right? So yeah, I mean, it's kind of the classic, blind man and the elephant, right? Or blind man and the elephant, where they're all kind of, touching the elephant but no one kind of has the full picture when it comes to digital assets. And so, that's really what my proposal is actually getting at is removing the CFTC from the equation entirely. And I have very good, reasons for wanting to do that. I mean, I think in effect they've been captured by the crypto sector. Obviously, I know you disagree with that, but they're also chronically underfunded, and they don't have an investor protection mandate. At the end of the day, this is what it's all about for me, and the SEC does have that investor protection mandate. So let's give the SEC exclusive oversight over spot and derivative markets for digital assets and kind of bring this into the traditional fold. Now, of course, some rules are going to have to be crafted to accommodate the unique nature of digital assets, but I think they can get there. So yeah, that's kind of where I'm coming down on. Again though, there's different proposals. I laid them out on my blog post. So Coinbase, for instance, has argued for a self-regulatory organization model, similar to kind of FINRA example, in the broker-dealer context. To me, it's sort of like letting the fox guard the hen house, right? And so I'm opposed to that.
Has been for FINRA.
Yeah, I know, right? And so, so Sam Bankman-Fried, back to him at FTX, he says, well, just, the CFTC, they're capable, they're already overseeing, crypto derivatives markets, just give them oversight over, crypto spot markets. And that makes kind of intuitive sense, given that they're already doing something in crypto. But as I just said, I don't think that's a great idea. Other people have said, let's create a new kind of digital assets regulator. This is so new. Existing agencies don't have the tech, the capabilities. I think there's just a lot of political challenges with creating a new agency. And so, so I kind of come out and give me to the FCC. But certainly, this is an area where I think, Congress is looking at. So let's move on, Jimmie, and actually gets to Carlos's comment here, because we did have this on the agenda for today. This is, in keeping with the broader, what I'll call institutionalization of crypto. So the big news yesterday was that Fidelity, which is the largest retirement plan sponsor in the country, is going to start providing Bitcoin in their plans. Now, this, employers will have to, choose to let their, employees, opt into this.
Participate, right?
Participate. So it's not necessarily going to happen automatically for all Fidelity plans, but nonetheless, they're going to make this happen. Fidelity's been making a big push in digital assets for a while, as you know,
yes, they have.
and right here in our backyard. Fidelity has a big operation in Research Triangle Parks. So there is, so Carlos, I'll get to your point because this does seem to kind of fly in the face of DOL guidance. All I'll say is that this is a very risky move by Fidelity from a legal standpoint. And I think, employers are going to think long and hard about the suitability of Bitcoin before they allow their employees to access these plans. Carlos posted a link to the DOL guidance. The Department of Labor, we generally think of them as overseeing like workplace safety and all these things, right? But they have this little carve out where they're allowed to oversee and regulate essentially 401k plans, employer-sponsored retirement plans. And they came out with guidance recently that said, sponsors and employers better think long and hard before they choose to allow their employees to invest in crypto. And that, in fact, they could be violating their fiduciary duty, the duty of loyalty and care, given the volatility, given the unregulated nature of these assets, or lightly regulated nature of these assets. So a lot of regulatory risk. I think, Vanguard has already come out and said, listen, we're not doing this. We don't think it's suitable. So, there's so let's talk, Jimmie, maybe about the suitability first here, right? Because, the whole point of 401ks is to save for your retirement.
It's right? To say, yeah, absolutely, to save for your retirement. Although it wasn't designed that way back in the 70s, but that's what it's come to do. It was meant to just augment your, it wasn't meant to replace, cafeteria plans and those kinds of things, but that's what it's come to. So yes, there is a little bit of an onus on employers. And so what a lot of employers have done is just given really, really bad generic products that it can never be sued over, and so I think those companies that are a little bit more adventurous, maybe a little bit more forward thinking, will provide this kind of access to employees. Maybe they'll limit it, maybe not. But I think that by providing this as an option, it does move this into a very different direction. In particular, given that it's Fidelity, as you said, this is the largest provider of plans in the country. So I think they are a leader in the space. They've certainly been at the forefront of administration and things along those lines. And so I would guess, if I had to, that the next big announcement from kind of traditional financial services will be someone like Citi probably coming out with custody services for digital assets. And that will, I think, take things to a very different level when you have custody being provided by a traditional financial services company, and now you have 401ks that are allowing it. This whole notion, and this speaks to that fragmented regulatory environment that we talked about before, that 401ks are administered by the Department of Labor. Most people find that shocking. They don't realize all ERISA accounts actually fall under the Department of Labor. And it's so antithetical to what we think about, right? When we think about the DOL, but that's who administers these kinds of things. I would make an argument for a complete overhaul of those kinds of things. I don't think you can break out your 401k from other things. I think it should be considered as part of your overall portfolio. And so the fact that you allow for a diversification of assets in a portfolio, I have no problem with that whatsoever, as you might expect. The fact that it includes one digital asset is not a terrible thing. And let's face it, right now I can buy exposure to a lot of digital assets through grayscale trusts and some ETFs and things like that. So even if I didn't allow that, I could still get the exposure. So it's just a different kind of exposure.
It is a different kind of exposure. I think the risk is it's legitimizing it as a long-term asset class in a way that it's just not, frankly. That's my belief. I mean, there's no reason to think that Bitcoin will go up indefinitely, right? I mean, that's not how it was built. I mean, its supporters, right? The Satoshi vision was, this is a peer-to-peer, medium of exchange. So, presumably you're investing for your retirement because you think these assets are going to continuously go up or over a long enough time.
Surprisingly, Lee, that if you polled people over 50 years old and asked them that question, what are you looking for in your retirement? Are you looking for preservation of capital, or are you looking for growth? Overwhelmingly, you would find preservation of capital.
Yeah, but that's over 50. I mean, you should be thinking about preservation of capital at that point.
It's just the reason they do it for 50 is those are people who actually have retirement savings.
Yeah, exactly. I know. Yeah, I mean, this coffee and crypto is not investment advice, right? So
no, absolutely not. No investment advice.
Yeah, so take everything we say here with a grain of salt. But I think, listen, it's super volatile. I tell my students, hey, if you want to invest in it, fine, but treat it like you're going to the casino. Don't bring more than you're willing to lose, right? So you have to look at your risk, your ability to take risk and your tolerance for risk. So
yeah, but I mean, Lee, is it any different than letting people invest in UCO or another leveraged? I mean, so UCOs are leveraged oil ETFs.
Yeah.
And there are a boatload of leveraged. Huh?
Isn't it USO?
The UCO.
Okay. Yeah.
USO is also an ETF on oil, but UCO is a leveraged ETF a leveraged ETF on oil.
Yeah, no, I would say those, listen, if Fidelity was offering that in their retirement plans, I'd say this is an awful idea as well. So, something to just keep your eye on, to see if this is the beginning of a trend or if Fidelity is going to go it alone here, and we'll see what the DOL's response is. But, very interesting development here. So we got 5 minutes left. I don't know if folks have questions. I think we had one other agenda item, Jimmie, which was stable coins.
Stable coins.
This is something we've repeatedly talked about on this show. I guess we can call it a show.
Yeah.
And so I want to get your thoughts on the rise of algorithmic stable coins, because I think in the past when we talked about stable coins, we talked about kind of the traditional, I guess to the extent anything in crypto can be called traditional, but the asset back, the tethers, the US dollar circles, right, where there's a reserve of fiat denominated assets, either cash in a bank account somewhere or treasury securities or tether, God knows what commercial paper. But we've seen pretty astounding growth in some of these algorithmic stable coins. Terra USD being the most notable example. I think its total supply outstanding right now is around $18 billion, which is nothing to sneeze at here.
No.
And the things that I've been reading, there's some differences in opinion within the crypto community here on algorithmic stable coins and the role they play and the dangers they pose. So what are your thoughts, Jimmie?
Yeah, I think that algorithmic stable. So I will say that one of the things that has happened is, we've already gone through this kind of a whole process, a whole a kind of I'll call it cycle almost around this. At the very beginning, I don't know if people remember, but we had something very similar to this probably 5-7 years ago. I know some of you have been in the space for a long time, and so this idea around some of the algorithmic stable coins is not, this is a new twist on it, but we have seen similar things at the very, at the I would say 5 years ago, probably 17, 18, we were seeing different kinds of coins that were out there, and some were algorithmic, some were based on algorithms, some were based on different kinds of assets or mixes of assets, things along those lines. So there are a lot of those out there, but these off-chain stable coins are usually, there is some kind of there is a huge difference between them. I think that when we're looking at these kinds of things, any kind of algorithmic stable coin or any sort of these are complex products, any sort of complex products, you need to understand kind of what this is and what they're doing. These typically, as you said, very plainly, these are not associated with some sort of a deposit or collateral or something like that. Things that are in a bank. These are brand new, and so they're being used for different kinds of purposes. And so I think that I can't give a blanket on these. What I would say is the same thing I would say for any kind of complex financial product is you better understand it. And if you don't understand it really well, the particular one you're looking to buy, don't do it. It's like people who invest in things like the VIX, the volatility index. I ask people all the time, when you bought into the VIX, what was that? And they always give me something about, the volatility index. And it's like, that is not what you bought. Let me clue you in that you didn't even come close to what you bought. And like the UCOs I mentioned just a minute ago, these are really complex instruments. They've reset at zero. You have to be you have to be very knowledgeable about these. So I would think that these are being used to provide different kinds of price stability services and things like that. But these are really complex instruments. And so I would say that if you don't understand it and you can't in a sentence or sentence explain exactly what the algorithmic stablecoin is that you're investing in, you shouldn't be.
And they have burned some pretty sophisticated investors before. So, Mark Cuban invested in Tron, right, and Titan, and
Yep.
that collapsed. So yeah, you're right. I mean, I think this is, once again, the industry is evolving at a pace that's challenging, regulators' ability to keep up. And so you've seen a lot of proposals around, regulating stable coins, and those are focused on, so-called payment stable coins, or, stable coins with actual fiat reserves. And here we have a new thing, and it doesn't, the proposals out there don't necessarily fit well with algorithmic stablecoins. And so, what do you do here? So,
yeah, I mean, to me, Lee, it's like a lot of things that are out there now that people can. I mean, a lot of the rules and things like that around derivatives and stuff like that are out there, and they're very plain. But I can buy some really esoteric derivatives with just a regular old stock account. Triple leveraged ETFs on the VIX and things like that. It's like inverse leveraged ETFs and crazy things like that. And all of a sudden, it's worth nothing, and I don't even know why it's not worth nothing. These kinds of things are out there. I would say you have to be very informed, whether it's algorithmic stablecoins or anything else that you're investing or you're buying into. Buyer beware.
Do your research. That is investment advice that we will stand by. So
there you go. Hey, you know what? I know we're at the top of the hour. It's been great. These are always fun.
Yeah, absolutely. It was a blast, Jimmie, as usual. And thanks to everyone who took time to join us, and be on the lookout for the YouTube link once it's available at the Pratt channel, or where can they find it?
On the Pratt YouTube channel. We will have this added to our other recordings.
Awesome. Thanks, everyone.
All right. Listen, thanks, everybody. Have a good day.